1. And welcome everybody to another Smart Money Circle show. I'm Adam Sarhan. With me today is Christopher J. Day, who's a founder and CEO at Day's Global Advisor. And Christopher, congratulations. He also just launched the DGA Absolute Return ETF. The ticker symbol is HF. Combined with the wealth management and the ETF and everything else Christopher's involved with, he manages over $500 million in assets under management. Christopher, thank you so much for coming on the show.
Absolutely. Pleasure to be here.
So I always like to ask Christopher, can you tell us a little about your story and how you got to where you are today, please?
Sure, absolutely. It actually started back in college. I went to Northeastern University, and instead of having internships, they have a mandatory co-op program. So I was introduced to a fintech startup there, and it was actually backed by, a person in the mutual fund industry, Michael Lipper. And, through that, I kind of learned about mutual funds and things like that. And when I graduated, I went down and worked for a family office in Palm Beach. And I was kind of trained in how to manage their portfolios in absolute return. And that's really where my story starts. And I've been doing absolute return portfolios on and off ever since.
I love that. So let's educate the audience a little bit in case if they're not familiar. Can you please let us know what exactly is absolute return?
Exactly. Absolute return. It is a way to look at your performance that is a little different than what's called relative return. So relative return would be, hey, the S&P was up 15% this year. I was up 16%. So you beat it by 1%. That was your relative return to the S&P. So if the S&P was down like last year, 22%, but you were only down 21%, technically you beat the S&P and you had a relative return. But you're still down 21%, whereas an absolute return talks about exactly what your return is. Your return is what you get. It's not relative to any benchmark. So if you lose 22%, you are down 22%. If you are up 10%, you are up 10%. It's very straightforward.
No, I love that. I'm a big fan of absolute return for what it's worth, and full disclosure out there. I think it's just a cleaner, easier way of measuring returns and all that fun stuff, because absolute return it's just dollars in, dollars out. Hey, I'm up or I'm down. It's binary type of a thing where it's much cleaner. All right, beautiful. Let us know a little about your investment strategy, please.
Sure. My investment strategy kind of comes from, my time in family office. And it basically is a global macro strategy. So it's not it takes out that unsystematic risk of individual companies. So it is a portfolio that you can use as core. But what differentiates it is there is a hedging overlay. And it's not, people think of hedging as in you're timing the market, but that's not really what's happening. It's a systematic hedging overlay that we use, and it incrementally manages the risk. So it decreases risk if the market's performing badly, and it increases risk if the market's performing well. And it does that systematically.
I love that. So let's shift gears and talk about risk management. What are some rules, or how do you handle risk, and what are some mistakes you see people make with respect to risk management?
I see people, risk management, definitely, either new traders or even new portfolio managers. I think they overposition their each position. They allocate too much to any one position, because that can really mess up returns. I know there's some studies out there about concentrated risk, and having, if you have 20 positions, it's the same thing as being diversified over a certain amount. But I've never adhered to that, because it only takes one or two companies that perform very badly to really detract from your performance as a portfolio manager.
No, I love that. So you're saying be careful. Don't get, even if you're really bullish or really believe on the quote unquote story, curb your enthusiasm type of a thing. You don't get too bullish on it, because otherwise you get too lopsided in the portfolio. Is that correct?
That is correct. Yes. I love the curb your enthusiasm. Yeah, that's a good visual.
Big fan of Larry David, for full disclosure again. Okay, beautiful. So what are some timeless lessons you've learned along the way that you'd like to share with the audience?
I think timeless lessons would be one of the things that has differentiated our performance over, a long term, and what differentiates what happens in family office versus what other people are doing. So say you have a 401k, you're in maybe a 60-40 allocation of stocks and bonds. The thing is that's kind of a passive asset class of investing.
Yeah.
And so therefore, they're kind of like in 2022, when the Federal Reserve was raising interest rates, they took a long time and they telegraphed, they told you exactly what was happening. So they gave you a lot of times to reduce your exposure in bonds. And just by avoiding bonds for 2022, you avoided a lot of downturns. I mean, a lot of people don't know this. And if you go and you look, long duration treasuries, which are supposed to be the most stable things,
Right.
yeah, they had basically the equivalent of a 2008 crash.
Yeah.
So if that was in your portfolio, that definitely was a drag on your performance.
That is so powerful. And how about the other side of the coin, timeless mistakes?
Oh, timeless mistakes. I would say, I would say one of the largest mistakes would be when you just let your portfolio go. Like you don't watch it. I mean, I understand passive investing to a point, but you do still need to watch your portfolio. And a lot of people don't. A lot of people don't. A lot of people, and they don't rebalance the portfolio. Rebalancing is a very, it can add a lot to the return over time by rebalancing, because there are times. Oh, go ahead.
I couldn't agree with you more. No, by all means.
Oh yeah. Because there's times when value stocks are I guess in season, and there are times when growth stocks are in season, and depending on when those cycles are, you want to be able to rebalance and have that exposure.
So let's go back for a second. You talked about your investment strategy. It's global macro. That means you look at the entire market, the universe, capital markets. You look at stocks, bonds, currencies, commodities, etc. And then you have a systematic approach for coming up with, I guess, stocks that are, or areas of the market that are undervalued versus areas that are overvalued. Is that correct? And then you build a portfolio that way?
Yeah, similar, but it's not really a value investing strategy. It's really based off statistical correlation. So what we're looking at correlations between different asset classes, and based on those correlations, the model will determine, whether or not those asset classes are in favor, and then help determine the exposure. So if you go and you look at all the math, equities have outperformed every asset class inflation adjusted. They really have. I mean, even if when you look at gold, you inflation adjusted, it's gold. So really, equities are the best asset class if you want to take full on risk. But if you want to start to hedge, then you want to reduce that exposure in equities, or kind of control it with a long short approach. And then there are certain times when commodities are in favor as well, and start to show those correlations where they start to outperform equity. So then that's when you add some commodities in. So it's more of a tactical approach versus a passive asset approach.
Okay, wonderful. That was my question. How do you actually position it? Because when you say growth and value, and they change, and then Treasury is 2008, so it's more of a tactical approach to investing. So you're going to look at the entire universe, find areas that you feel are attractive, and then allocate to those areas, and then take away from the areas that are not attractive. Is that a good way of summarizing?
Correct. Okay.
Correct. Wonderful.
And that helps you because you don't necessarily have to know how an area is going to perform. You just have to have a nice measured exposure. And then when that area starts to outperform, you say, okay, well, my job is to manage the risks. So I take off those profits and I add to areas where, there's potential to catch up.
Got it. Okay, wonderful. And that's the rebalancing that you spoke about earlier, so the audience can follow along.
Correct. Yes.
Got it. Beautiful. All right, Christopher, the next question for you. What's the best piece of advice you'd like to share with the audience, or give your 30-year-old self?
Oh, if I could go back and give my 30-year-old self, I would definitely shy away from excessive consumerism. And, I would have definitely, I think, not necessarily saved more, but actually invested more. I mean, that would be for anybody, I'm sure, because time is what matters in investing. The best time to invest is yesterday. The next best time is now. So that is really what I would focus on. And also I would have started to look at things besides 60-40 portfolios. I mean, there's a reason why these models have existed in 401ks for a long time. I guess, yes, in some instances they're time tested, but you got to kind of think for yourself, because when things hit like 2008 and you have global volatility, all assets classes start to converge in correlation. So,
Yeah.
so that
That,
would be
yeah.
something I would tell myself.
Yeah, no, that makes perfect sense. So let's talk about the ETF because I know that's very exciting news and congratulations for
Thank you.
ticker symbols HF again.
Mhm.
Tell us about how you that came to mind and the journey and how you brought it to life, please.
Absolutely, absolutely. That goes all the way back to the first family office that I worked with. And I was trained by them. And it was actually a former specialist of Spear, Leeds, and Kellogg. I think they're Goldman now, but they taught me kind of a framework in how to look at the market. And I was doing it manually with spreadsheets and on a Ready Plus platform, and and pulling my hair out. But over the 20 years, we've refined it to where it now runs, in a virtual cloud, and the model's there, and that's really how it kind of evolved. So it's really a way to look at the market that's not a passive asset class investing, and to look at it as a framework of correlations between different asset classes.
I love it. And that's available. Anyone can buy that, whether a financial advisor, big institution, individual investor, it's open to everybody.
Absolutely, and that's really the reason why I did it. Normally, somebody would take a strategy like this and do a 2 and 20, and call it a day. But I one of the things I'm very passionate about is global financial inclusion, and that's why I went through the regulatory process, and to have it come out as a ETF for everyone.
Got it. I love it. Well,
Transparent
thank
and
yeah.
available.
I love it. Thank you so much for that. And then what is the best way for people to get a hold of you, or do you have a website that you want to share with the audience?
Absolutely. My website is www.daysadvisors.com. And there you can learn about the firm. You can learn about the ETF. There's an education section that kind of goes over the absolute return kind of basics of the math, because really it's elegant math that works in your favor over time. That's what it is.
I love it. I love it. There's a great book called The Slight Edge, Christopher, where the guy talks about just getting a slight edge, a little bit every day, small wins, and adds up something really, really big over time, the compounding effect. And it sounds like
Exactly.
exactly what you're doing from the numbers and math. I love it. Well, Christopher, thank you so much for coming on the show. This has been very
Mhm.
delightful. Thank you.
Oh, thank you so much for having me. All right. Take care, Adam. You have